L&T Finance obviously has demonstrated strong results this quarter. And on your question on credit cost, if you look at the trajectory of our credit cost, right? So over the last, maybe if I can sort of rewind across the last 3 quarters, we were at 3.83, we came down to 3.4, and then from 2.98, and currently we are at about 2.83 this quarter. But you have to keep in mind that the 2.83 this quarter is because of a one-time impact of 23 crores on account of prudential provisions on certain co-borrower cross-linkages that we have decided to provide in this particular quarter's P&L. Obviously, this will become a BAU item going forward. If I were to take away the exceptional impact of 23 crores on cross because of co-borrower linkages, the actual core credit cost, that means credit cost from operations, is about 2.74%, which is about a 25 basis points fall over what we saw last quarter. Now, as we have guided, the credit cost will come to a range of 2 to 2.2% by Q4 FY27. And as we go through the next couple of quarters, you will see a paring down of credit cost. Obviously, credit costs do not move in a metronomic fashion or in an absolute, spreadsheet type regularity. There are small kinks here and there. But the fact is that if you see the trajectory of the credit cost, it is firmly on the trajectory downwards, and you will see it approaching that 2 to 2.2% mark that we have guided by Q4 FY27.
Okay. So there's scope for around 75 basis points of reduction at the lower end of the band. And this is, of course, core credit cost. The one-offs, firstly, let's try and get a sense of what that is and how some of those factors are shaping up for you, because there have been times when credit cost has been choppy for you in terms of one-offs. Are you comfortable that a lot of this is now completely and prudently provided for? And also give us some color on the one-off this quarter.
Yeah, so the color on the one-off this quarter is that, we have taken a very conservative interpretation of the cross-borrower linkages. That means, if there is a particular customer who is a co-borrower in one particular loan, and if that customer has another loan, individual loan, and if this particular loan in which this customer is a co-borrower is non-performing, though the other loan might be a standard asset, we have decided to provide fully against the other standard asset as well. This is on the regulator's guidance, and as I said, this is a one-time sort of 23 crore provision that we have taken this quarter, and this will become part of BAU provisioning going forward. In terms of the credit cost trajectory for all our lines of business, if you see the headline collection efficiency for our microfinance business, which is our largest business, this quarter we hit 99.7% zero DPD collection efficiency. So obviously, you can see that pairing off, very, very significantly, and we expect FY27 to a very normal operating year for our microfinance business. And as you know, that last 18 months were a issue with relating to the credit performance of this business across the industry, though we were one of the players who are least impacted. The impact of Cyclops, continues unabated in our two-wheeler business or SME business as well as our tractor business. Our gross non-starters in the two-wheeler business as well as the farm business continue pairing off. And if you look at overall trajectory of our retail asset quality, our retail GS3 is currently at about 2.83%. Our retail NS3 is currently about 0.77%. And our slippages this quarter actually has been coming down. Our slippages in this quarter has been only about 200 crores. So as we go forward over the next couple of quarters, with every passing quarter, you will see an improvement of the credit cost trajectory. In some quarters, yes, the improvement might not be, a huge fall downwards, but you will see a gradual sloping down of the credit cost trajectory, and it will bring us close to that 2 to 2.2% threshold that we have guided for Q4 FY27. So we remain very confident about the trajectory. As you can see, over the last quarter, we have been bringing it down, right? Yes, for the last 3 quarters prior to this quarter, it was pairing down by about 40 basis points a quarter. This quarter, it has paired down by about 25 basis points this quarter if I look at the core credit cost. And I'm very, very certain that this particular trajectory will continue going forward, reaching to that particular threshold that we have guided.
Right. Fair point. if I were to switch focus to margins, that's where a lot of the positivity comes from. 10.4%, you've guided for a band of 10 to 10.5. I'm trying to get a sense, Mr. Roy, whether margins can surprise on the upside for you, given the kind of rate cuts that we've seen. How much of your book has already been repriced in terms of your borrowing book? And how much of this are you pushing to your lending book? So give us a sense as to how much of margins are you retaining, because there could be another 25 basis points rate cut. Does that mean, firstly, are we at steady state margins at 10.4? Are all the rate cuts priced in? And now going forward, how much of the rate cuts will you accrue to margins?
See, we have always guided the markets that we'll try to maintain our NIMs and fees between the 10 to 10.5% range. As you can see, this quarter, our NIMs and fees have moved northwards. We have moved from about 10.22 to about 10.41. So that has been an expansion. Now, this has been driven by two things. Obviously, we have been pushing margin improvement in our core lines of business, as well as we have been also working on our weighted average cost of borrowing. To your question, whether the entire sort of rate cuts have been fully priced in, the recent rate cut has 25 basis points rate cut has not yet been fully priced in, and I do believe some more rate transmission can happen this particular quarter, and our treasury teams are working on it to take full benefit of it. And also on the lending side, because the microfinance business disbursement you have seen this particular quarter has gone up to about 6,700 crores, which has been quite a strong recovery from what it was previously. We have seen our margins improve on the lending side as well. If I were to sort of break down the sort of improvement in NIMs and fees this particular quarter, you can see roughly about 10 basis points has come from the lending side of the business, and about 7 basis points has come from the weighted average cost of borrowing efficiency. So the push on the lending side to improve our margins has been working, and we'll keep on pushing on that. As you know, our gold finance business is building. Gold finance is a high yield secured product. We are pushing yields on our two-wheeler business as well as pushing yields on upwards on our personal loans business, as well as on our SME business. However, on the home loan business, there remains a pressure on our yields, and that is why we have been focusing more towards loan against property as a proportion of our disbursements rather than the core home loans. You will see this calibration continuing. I think we are more or less, we will remain range bound between this 10 to 10.5 level with a little bit upward bias. But however, we need to see how, Q4 pans out, because Q4 typically is also a strong quarter for the BFSI quarter. And we expect to sort of retain our NIMs and fees trajectory in this quarter as well.
Perfect. And with the 7% growth that you've clocked this quarter sequentially, that's extremely strong. Gold loans is one of those levers that you've used. Do you continue to grow gold in aggressive fashion? Are there any risks that you're building in with regard to gold? If prices were to fall, would that hamper growth? Are you very, very confident, comfortable of probably achieving the higher end of the 20 to 25% growth guidance?
See, again, our growth guidance has been between 20 to 25%, and this quarter has been a strong growth in terms of AUM growth, and primarily because we had a very good momentum post the GS2 2.0 reforms. Our gold business continues to sort of scale well. We are adding one branch every day. So by about 31st March of this year, we will have 330 branches, of which about 200 branches will be new. Our new branches continue to scale very well. On your question, yes, we are mindful of the possible volatility in the gold prices, and that is why we are maintaining a very strong control on the LTVs in line with the RBI guidelines. Also, we continue to do stress testing on our gold portfolio to see what is the impact on the portfolio if the gold prices were sort of dip across a period of time. To be noted in point, the recent auctions that we have done, our realizations have been upwards of 140% of the value of the auction. So obviously we have returned the excess to the customers. So I think we remain in the gold finance business, we remain very well provided against any unforeseen shocks. Our LTVs are at a particularly comfortable level. And as we scale up, we are very, very confident that we'll be able to sort of manage any sort of risks that might arise out of this business. In terms of the growth on the other lines of business, as I said, Q4 in all BFSI is normally a strong quarter. So we expect this quarter to be a strong quarter as well. But, to sort of comment on whether we'll be on the higher side of the 20 to 25% guidance will be a little premature right now. I just hope that, the sort of the strong momentum that we have seen last quarter sustains and we are able to deliver a result which is acceptable to the market.